Right. Hello, Jack. Welcome to the podcast. This is, I guess you're the second person we're interviewing, or I'm interviewing for the podcast. So that's pretty cool. Thanks for joining. Could you give a quick intro about yourself, what you're up to, and what interests you in the crypto or tokenomics space?
Sure. Thank you for having me, Florin. I'm a big fan of the Tokenomics DAO and the Substack reader. And a bit of intro about myself. I study philosophy, politics, and economics at Oxford, but I spend a lot of my time building products and companies. So you can basically call me a tech startup guy. Before going to Web3, I had a biotech startup, and I also worked in product and sales for early stage AI SaaS company as well. So basically my mental models are, especially as you can tell in our conversation, very much draws parallels from the social sciences, first principles thinking, and also some product frameworks from Web2, which is the world that I was in. And currently in Web3, right now I'm working for Frigg, which is a company that tokenizes real world assets and bring green bond on chain.
Okay. Yeah. What type of real world assets? I saw the website and was kind of, it sounded interesting, but I didn't really look into it.
Yeah, that's a really good question. So we think from first principles, what is the value proposition of DeFi? So DeFi is a very low transaction cost and instant settlement, and basically very low barrier to entry, right? Everybody in the world, you can participate. There isn't much of a banking barrier, so to speak, compared to TradFi. And we also look at TradFi, where all of the above mentioned benefits do not exist, basically. And so the question becomes, what niche within TradFi is DeFi 10x better than TradFi? So we decided, we did some research, and we thought that it's actually infrastructure as an asset class that is massive and filled with a lot of intermediaries and brokers that takes up a lot of transaction cost. And the founder of Frigg, his business background, family background is also in infrastructure financing. So there's a good founder market fit there. So what we do is we basically help project developers and infrastructure funds. We help them refinance operational assets. So imagine there's a dam that's already been built, and this fund 10 years ago invested either in equity or bond to build this dam. Now 10 years have passed, and water is going through, electricity is being generated, and cash flow is very secure. The traditional way for the investor to get liquidity is to shop around, talk to investment banks, talk to merchant banks. However, the market is very inefficient, and these transaction costs take up anything from 8 to 15% and even more in emerging markets asset. Now we bring these assets, tokenize these bonds, tokenize them into bond token, and we bring DeFi liquidity. So we bring sustainable yield DeFi. Yield is no longer Tokenomics, and it's actually uncorrelated returns from the secure cash flow, and it's also green because these are all sustainable energy infrastructure.
So in a way, then you're trying to bring the assets on chain and represent them with their yields.
So we actually bring the debt. We actually bring the bond part in TradFi, which is tokenized the bond part. But the roadmap, our vision is definitely to. So we start with basically refinancing already operational assets, right?
Yeah.
The next step in our game is to finance building new assets and building new solar farms and new sites. That's a lot trickier because it involves a lot of stakeholders, and from our perspective, it's actually mostly a trust issue. There's a lot of attempts to tokenize real world assets or to bring real world assets to DeFi, and a lot of it really miss the crux of the game, which is if you have your own native token, you get these validators, mechanism, etc. In an average participant, either retail or institution, cannot really participate, and it just makes everything seem dodgy as well. Whereas for us, we kind of underwrite, or we kind of internalize the risk and just say, right, we only work with blue chip funds and project developers with the right, we take on the compliance cost, we set up our own standard, we go on the ground, make sure everything is as it is, right? So yeah, start with operational, and then we'll do building up new assets.
Yeah. Okay. Yeah, that's super interesting. I wrote this piece, or two pieces actually, on Citadel, and
Yep.
I don't know if you've seen that. They're this company in Singapore, and their plan is to bring all sorts of real estate assets onto on chain, right? And
Yep.
I guess they're attempting a similar process where they spot them like in the real world, and then
Yep.
try to then acquire them into a holding company or something like that, and then bring them on chain via that. And the interesting part was actually like this whole process, it's cool. And once we have that, that's pretty nice. We'll have a good piece of infrastructure. But then once that process is at a stage where you can leverage then this infrastructure, i.e. that you have tokenized real estate, you have these tokens, then it becomes really interesting because you can like funnel that into all sorts of DeFi applications, right?
Yeah.
And I guess that's probably also something you were thinking about then, not only to have that debt, but also, I guess like some other applications for it in the DeFi
Exactly.
world.
Yeah, that's a really good point. That's composability in DeFi, right?
Yeah.
And I guess slightly different from Citadel. Citadel acquires new asset, whereas we can think of us as initially as in just an investment bank, right? That bridges between TradFi and DeFi. But composability is top of our list when it comes to us setting the contract standard or thinking about how to make sure there's secondary liquidity for token holders. A key value proposition for DeFi, like if you ask me, why would investors want to buy a bond token that tokenizes a real world asset? Well, for institutions, there's already a lot of workflows and brokers and banks in place. So there has to be something that's 10x better than the status quo for them to switch, right? And what we observe is, because value is encoded in lines of code in smart contract in DeFi. And so, if you, for a new protocol, for a new lending protocol to accept these tokens as collateral, you don't need to go through the whole okay, what's the software stack that your bank uses? That's the TradFi process, and the DeFi is so much easier. And so the future that we see is, you can get people betting on yields, right? You can have these bonds. You can have people packaging financial products on top of these bonds, and I think it's true that these products exist in TradFi, but they are reserved only for like large institutions. If you're Blackstone, you can still get packaged structured financial products if you work with Goldman Sachs, but it's going to take 3 months. They're going to hire, they're going to build you for 100 hours for the Harvard graduate analyst to do the work. Whereas for us, it's plug and play.
Yeah. I think that's also the interesting proposition for projects like Citadel, because they make it accessible for anyone to buy, like whatever their risk appetite is and whatever their amount of money that they have on the side that they can kind of put into this. So yeah, that's, I guess those are like in some way I called it like this, a Trojan horse. There's lots of Trojan horses, I guess, in the whole DeFi world, but this could be one in getting more people to use it, because then if that enables you to invest in real estate and or in infrastructure, then that's a pretty cool thing. It would probably get more people to join. Yeah. Anyway, cool. So without, the actual idea of getting you on and talking to you was a paper that you wrote, I guess, for your uni degree, or as part of your Oxford studies, whatever you do there, in this different field. And you called it the 3 tokenomic problems and a productivity linked tokenomics design. And I thought that was quite interesting. Can you maybe give us a really brief explanation of what that paper is about?
Sure, yeah. So, as the title suggests, there are two parts to this paper. There's the problem part, and there's the sort of an attempt to solve the problem. The problem part basically consists of what I like to identify the three tokenomics problem that's overarching in crypto and DeFi right now. So, if you look at the past bull market, it's true that we get a lot of new tokenomics design, but sometimes like the motivation for me to write the paper was just thinking from first principles. Like, it's nice that we get Olympus POL, or we get a phase PCV, but like behind all of that, like if I were a founder, just how would I design a tokenomics, from first principles, from scratch? And so it just comes down to several variables, right? What's the initial token supply? How much of that's going to be circulating? How should I allocate my token? And what's the token emission schedule? So all of it, I think right now, founders and designers and investors and community usually just resort to, right, let's look at, what other protocols have done. It's very much sort of thinking by reference rather than thinking from first principles. So more specifically, the three tokenomics problem concern token allocation, token emission, and token value. So if you think about it, it's sort of in order of abstraction as well. So token allocation, as I suggest, we can go a lot more detail in this, but basically it's just thinking how much to allocate to insiders, how much to allocate to liquidity miners, etc., with the ultimate goal of aligning incentives, right? And this incentive can be defined as, maybe driving total transaction volume of a particular protocol, or it can be number of users, depends on how you define it. So that's the first problem, token allocation. The second problem is token emission. And token emission is really interesting, particularly because Curve, right? Curve has taken a lot of the narrative energy right now. Everybody's talking about the Curve wars, and the killer app that Curve has is basically Curve emission. So I thought that we haven't, the community hasn't really thought about how we should do emission, and it's a question of how many tokens are emitted at a particular time and how quick, which is the time question. So what to emit, well, how much to emit, and when to emit. And if you set your emission curves in a different way, that's going to affect it's going to affect the ultimate goal that you're defining as well, right? And current token emission designs are prone to manipulation, and that's the second problem that I identified. The third problem is token value, and how token value detaches from real value creation. And what I mean by that is basically you get tokens are trading 10x, 15x, or 20x more than economically, theoretically, they should trade at. And the way we theoretically arrive at a fair price of a token is, you can say it's, the two ways, right? There's sort of market-driven value, which is basically just marginal benefit of using the token is equivalent to the marginal cost, which is the price. That's a more, if we believe in market equilibrium. The second, more intrinsic value investment philosophy way to calculate token value is to look at net present cash flow value, right? How much is this token generating? And my point is basically just there's a lot of speculative token holders that once they hold tokens, they don't actually contribute to the protocol. And this contribution can be, it can be actual community contribution, or it can be economic contribution, such as using the protocol itself. And so when that problem happens, you get rent extraction. Token holders just suck marginal benefits out of the protocol. So these three are the tokenomics problems.
Yeah. So maybe I guess like I read through it, and I was like interested in a few things. One of them on the emission side was like where you said setting emission curves without experimentation is testing in production, and that's obviously something software people know that that's not a good thing to do. But obviously, I guess, and I talked about this on the recent podcast as well with Javier. how do you get around this, right? You can't simulate everything and all of your ideas. So what's kind of the best way to experiment with like emissions and try this out? Like what's the dev or the test environment that we could have to try out things like that?
So that's interesting. So I personally don't know much about token engineering, just a disclaimer, but I think one of the ways to do it is probably run agent-based simulation and test different emission schedule. So I don't know, products like Gotlig, or there's another one coming up, Chaos Lab. These products might be useful. If a emerging protocol doesn't want to use these products, they could be expensive. Then I guess a simple way to do is just explain from first principles why you chose this over another. I think a lot of white papers or documentation just take it for granted. We have this emission curve, but like why?
So how would you do that? Like from first principles, like maybe like, you've been saying that a lot, and I wanted to touch upon it, but maybe now's a good point. Like, can you like walk us through how this like first principle tokenomics design in your mind would work? Like what kind of questions would you ask especially, maybe let's start with emissions and see how you would think that through.
Sure. Yeah, sure. So, and this would actually lead to the second section of the paper, right? The productivity linked tokenomics, which is a solution, a suggestion that I came up with, and obviously it's a draft. So I welcome listeners to give us comments as well. So I guess when we say from first principles, it basically means like from the ground up, from facts, right? And also thinking about it's very purpose-driven design. So what's the purpose of a tokenomics design? And it depends on, if I were let's say a lending protocol, then I would want maybe total transaction volume, people lending and borrowing, and you come up with a proxy that sort of measure the weighting for each. Basically, I just want as many people to lend and borrow on my protocol as possible. That's the thing that incentivizes. So given that is the purpose, then we think about, right, and if we have a native token, then how should we design it? So when it comes to emission, the first question is emission quantity, right? So how many new tokens are available at a particular time? And the way I think about it is, right, relative to total supply, what's the percentage of new supply is emitted at a particular time?
And why is that even needed, right? Like, why do we need to emit new tokens at all? Like that's probably one of the questions, right? That should be started with, I guess, in a thought process like that, right?
Exactly. That percentage can be 0%. And if there's zero new token emitted, kind of similar to the Bitcoin dynamics, right? Kind of the concept that there's fixed supply. Obviously, Bitcoin has a different nuance there because miners have to mine Bitcoin. But you can have a similar dynamic for this imaginary tokenomics design we're talking about as well. And I guess the argument against 0% emission is basically that it's the same argument that central banks have for why inflation shouldn't be 0%. It's because if you have some form of slight inflation, it encourages people to spend the money and not to hold the token. And so as you can tell, even like we just posed one question, right? Emission quantity, how many new tokens are available at a particular time? And we already see like so many different possible paths. And within each path, there are different implications. If you set 10%, the implication is, that's quite high inflation, judging from, if we look at comparable protocols right now that are dominant in DeFi. If we set it 0%, then you get this theoretical counter argument of, people are going to hold the token, they're not going to spend it. And so there's so many criteria and decisions to consider that's missing in current discussion. So that's the point that I'm driving at.
Yeah, no, I totally get that. And I guess it all comes down, and I hope we can talk about that in a bit, about this the suggestion that you've made, and I've written about that a little bit as well. And it's really this, like, what are you actually trying to achieve with it, right? That like drives this emission. So a thought that I had, or that we had with Tokenomics, that was launching our token, was to think through kind of how do we actually want to create this token, right? And in our mind, it was connected to content, because we've thought about this flywheel, right? So we produce this content, and the content that we create is then the gravity that brings in more people to join our DAO, potentially new clients that want to do consulting gigs with us, premium subscribers to content and stuff like that. They would come in, and the content is kind of doing that. But in order to keep people to produce content, you could issue a token for every piece of content that is created. Like, so every bit of value that you create, and that would kind of be your emissions, right? And so those emissions would be ultimately tied to this like basic creation of value, right? And so they could be higher if we produce a lot of content, and that then on the other side turns into cash flows or revenues that we achieve. Then the emissions could be higher. But if we don't produce a lot of content, they should be lower, right? So it's ultimately like tied to something. And I guess that's I hope what you really like mean with this, like thinking from first principles, like where starting at the facts of what you really want to achieve, and then tipping it that way, right?
Yeah, exactly. And the design that you mentioned, it's very much in line of the spirit of the productivity linked tokenomics design as well.
Yeah.
Whereas in this case, productivity is defined as new content produced. And, you can even have a more nuanced definition of that. It can be a weighted average of a piece of, let's say a user produces 2 pieces of content. One piece goes viral, and the other piece, like, nobody reads it. So you kind of need like you need an indicator, you need a proxy to sort of calculate the weighted average of that, and that could be the ultimate purpose, or the ultimate KPI that your tokenomics is driving for. And then from then, when we talk about emission, then yes, exactly. When the whole system and the whole DAO is productive, then the DAO issues more tokens, and it rewards creators proportionately as well. I guess that's an intuitive design, although I did mention some concerns and limitations in the paper as well.
Yeah, maybe we can get, I guess it was a Matthew effect and some other things. So maybe we can, let's maybe get into that. So the Matthew effect is roughly like this: the rich get richer and the poor get poorer. The scheme, is that like a, I'm not in academia, so I'm not sure if this was like a fair summary of what it is, but
no, that's absolutely right. It's absolutely right. It's the reason why it's called Matthew is just because it comes from the Bible, and I think the Bible, the quote was the people who are receiving a lot, they will continue to receive, and people who haven't, they will be sort of ignored. I forgot the exact quote.
But that's something you would have like a lot in like proof of stake systems, right? So the ones that have a lot of capital, they can they can stake that and then receive more from it. So that's a problem that you also see in this like productivity linked tokenomics design scheme. Exactly.
That's a problem that so I actually I posted a Twitter thread this afternoon. So unsurprisingly or surprisingly, Ryan Wilkins at Mozari actually addressed this back in 2020. And he wrote a blog post on Mozari called Power and Wealth in Crypto Economies, and crypto economies. And the point he was driving at is precisely sort of this idea of the rich gets richer, and more specifically, he was addressing POS systems where initially allocated token holders, if they choose to stake the token all the way through, then at a time long enough, like they will basically hold a majority of tokens. And then you also get this collusion dynamic between them as well. And in a sense, if they collude with other whale validators, they can just rewrite the whole chain.
Yeah. So a way to address that, like not on the blockchain level maybe, but like on a more on a protocol level, I was thinking about the design that we just talked about like that for us at Tokenomics, that we would issue new tokens for content. And maybe these tokens would give you governance rights, and they would maybe give you a share of the revenue if you stake them. But if it is the case that you need to create content to receive then your share over time would get diluted, right? And also your governance share. So if you have, and especially if you have like a high inflation, let's say we produce a lot of content, we produce a lot of new tokens, we'd have sort of a high inflation of our token, and that would then over time dilute your governance power if you stop doing something. So it actually solves this problem of rich getting richer and poor getting poorer, because you're churning out so many tokens, but you're tying it to something that needs to be created. So the rich can't just stake their tokens and receive more. They have to actually also do something. And if they don't, after a year or two, their voting power or their yields will be halved. We'll have this halving every year or something like that. I mean, you could definitely program this into that. Would that be a solution to the potential, like to this Matthew effect?
Yes and no.
On the emission side,
I think that definitely solves the idle capital sort of. Well, this is very much in line with the Marxist critique of capitalism as well, where he criticized how in capitalist and hyper-capitalist societies, capital owners don't have to work and they just make more money off money. I think that tokenomics design solves it. But another problem then becomes it kind of disincentivizes early productive people to join it, because they know that they have to continue to churn out valuable content, which could be good or bad. I think it's good on the aggregate level. It helps with fairness, but on the individual level, maybe we can sort of caveat that design, right? And the difference here is, in my tokenomics design, I sort of assume that an agent, if you're productive, you will remain productive forever. Mm-hmm. So in a sense, right? And that's why I said my design is still vulnerable to Matthew's effect, because a good writer will presumably continue to write good content and to have several hits. So I guess maybe you can have maybe like a basic level of compensation, or some form that can incentivize regular good contribution. Otherwise, you might see some high quality writers lose the interest or lose the energy, especially in writing, right? Where I think it's very much like a burst of creativity rather than a regular sprint of like a regular jog of creativity.
Yeah, so that's interesting. I guess like to solve this problem, you'd have to find this balance between incentivizing regular contribution, but on the other side also like retaining and attracting this early talent, and also getting them to join in early before there's money to be made. So yeah, that's something I think still for us still a nut to crack and think about, kind of how we could do this.
Yeah, exactly. And especially when you tie in when you tie into price of the token itself, right? Then you get a sort of slightly more reflexive problem of, right, how much is a tokenomics DAO token worth? Yeah.
And if it's like highly or like semi-highly inflationary, then it'll be hard to achieve a high price in token. But on the other side, it would be like this. I mean, it would essentially be very much tied to the intrinsic value of the token, right? Or very close, right? And that kind of brings me to this second, or one of the second problems that you stated in your paper, right? So a quote again was, given that most protocols launch early in their product lifecycle, there's high uncertainty around the intrinsic value of protocol tokens, right? I guess like that's definitely something. And because of that intrinsic value, it's hard to get people to like commit and join early on, because nobody knows what's going to happen. Like some people, especially the founders, they'd have a vision or an idea of what could happen, but nobody knows, right? So it's hard to link the token value to the real value creation. But that kind of would be an attempt. So, but I'm still struggling with this balance. Maybe you can kind of elaborate a little bit more on this second problem that you've stated in your paper.
Yeah, by this you mean token emission, right?
No, we just talked about token emission. I would now like to go into the token value side, where you said,
right.
you know,
yes,
yeah, with real value creation, you have this incentive misalignment, and therefore, I guess it needs to be tied in some way to the intrinsic value of the protocol.
Yeah, for sure. I think we've sort of, in the crypto community, we've sort of accepted the norm that in the bootstrapping phase of a protocol, token values are completely detached from its real value. And the reason why we've accepted it is because we think it's like it's a necessary evil to incentivize early adopters, right? And you get this, there's plenty of literature, plenty of blogs about the sort of S-curve network effects and how real utility plus token utility can help, solving the cold start problem. I think that's all right. Like I see the valid argument, but I just wonder if there is a way to, because there is a lot of dead weight token holders, and the Web2 parallel for this is basically, if you have a company and you get some early investors, but they are useless as the company scales, right? And somehow you need to buy them out. I think there is a similar dynamic here where some insiders or some early adopters, they might not necessarily help with scaling. And so you get this another question of, right, how can we filter out, how can we reward early adopters, financially reward early adopters that are truly sort of true-hearted network participants rather than speculators who don't contribute to this. And I guess there are already some attempts, some do like auction mechanisms, sort of different types of initial token drop, like airdrops, right? If you look at LooksRare, they airdropped it to power users of OpenSea, which is a good proxy value to measure, to predict how much NFT transaction fees they would drive to LooksRare if they use LooksRare. But obviously you also get another problem of, once you define a goal, once you define a KPI, then everybody's going to find some way to game the KPI.
That's
they
what
might do wash trading.
Case.
So, for Tokenomics DAO's case, maybe you can have a, the very specific measurement of these KPIs. You have to write a 800 words, at least 800 words article, and it's had been submitted and receive sort of 10 likes or on Twitter or whatever. And so then you kind of solve this wash trading issue, and you also basically tell writers, it's a minimum acceptable amount of quality over quantity.
Yeah, it needs to be linked to quality, right? That's definitely something. Yeah. Okay. So, and then on the third problem, then on the token allocation, what are your thoughts on that? I mean, you talked a little bit about like long term. How do you allocate tokens for the long term? Like that's another problem, I guess, that you could maybe go into for us.
Yeah, definitely. So I don't have a very well thought out answer. I think my thinking right now has just been very analytical rather than prescriptive. But an intuition I have is there should not be any preset allocation at all. Let's just like do this imaginary experiment where you only have initial supply, And similar to the Bitcoin dynamics or Ethereum pre-mine dynamics, you get miners, which can be generalized as participants and users of this protocol. They have to do certain actions in order to gain a token. And we just sort of take it for granted that the initial state of affairs, maybe there will be 10 agents that participate in this initial round of mining or gaining tokens, and that will be the allocation. That will be the initial token allocation. So there's no sort of hidden hand, or there's no sort of like God view to allocate token supply. You just leave it to the market to decide. That could be a good experiment to run.
But how would you run this on a protocol level?
Yeah, so it depends on what the protocol does. I'm actually, when I talked about this experiment, I was thinking more about L1s and just leaving it to dApps to race and to drive transaction volume, and then my L1 is going to allocate L1 tokens, native tokens to them. I guess if it's a dApp or if it's a DAO, it could be, let's say you have similar to the mirror right race, right? You get this race where you allocate the total supply of tokens. It can be, let's say, just for the sake of simplicity, 100 tokenomics DAO tokens, and you market it in advance early enough, and you get 100 writers that are competing and write in order to gain a portion of the initial supply. And that could be the way that you use token allocation. It's kind of similar to another parallel I draw, and sorry if I'm talking too abstract, is to think about initial token supply as sort of like a new continent. How do you decide? How do you divide land on a new continent? Let's say the colonizers of the North American of the United States. How did they decide how to divide the land? Well, whoever came first and whoever did productive work on them, whoever built farms, built houses, then this land is yours. It's a sort of similar spirit that I think we should, at least, I'm not sure if it's robust across like all the different edge cases, if it's completely safe and nobody can cheat. There's probably some way to cheat, but it could be a cool experiment to run.
Yeah, definitely. Yeah, if you find out something like the right race is interesting. Like for the people who don't know, like, I don't know, like it was last year sometime, Mirror XYZ came out, which is kind of a decentralized medium. And they then allocated tokens. I guess, I think they must have allocated to some people upfront. And then there was this race every week where you could submit what you wanted to write about. And then people could allocate their tokens that they had received to you to then get a slot on the page so that you could get like a publication on Mirror. And I guess the problem with that was that only like their peers got the initial tokens. So for somebody like completely random to get in was quite hard and receive tokens. So that's something I guess you'd also have to balance with this kind of mechanism. But yeah, proof of work seems to be the best way, right? You can just bring it out there, and then whoever contributes work, he'll get some tokens, and that's your allocation, right? It's not predefined or anything.
Definitely, I share your thoughts about Mirror. I got into blogging fairly recently, and when I looked at Mirror, that was amazing. And I wanted to participate in Right Race, but I don't have a large enough Twitter following. I'm like a new writer, I haven't got like a good portfolio to show, and that was difficult for me to participate. So that definitely is a problem for a Right Race model that disincentivizes small and emerging sort of users and participants. And on the other hand, maybe we can even push it further. Maybe that a protocol, maybe like how much a team should get in terms of token supply should not be determined at all. Maybe that what the team should at a bare minimum do is just to build out the infrastructure layer for this protocol, maybe set up website, Twitter account, whatever. And then everything else, like after that, like what products to launch, whatever, like that actually determine how much tokens the teams should be allocated. And the way to do so, and this determination is calculated mathematically via the curve. So if it's a productivity linked design, then it will be, since day zero, right, this protocol is live. And then the team, the founders, the founding team, they have to do certain action, that's productive by definition. And then the curve, which is a smart contract, which just emits and allocates the proportional share of token supply. That could be another extreme.
Yeah. I guess the problem, and I guess I think that's also one of the problems that you talked about the Matthew effect, but that's also one of the problems that you've stated in your piece is like, how do you actually measure productivity in a good way, right? How do you actually define that and find out how many tokens was that worth to create the website, the infrastructure, and the initial protocol? Who's going to decide about that, right? If you say the founders shouldn't decide it, who else should define it? And I was thinking like the way a few other protocols did. I know that Bankless DAO, when they launched their token, they airdropped all the tokens to initial subscribers and readers and members and things like that. And then they had a Genesis proposal where they said that the founders of the podcast, they would get a certain allocation. And then it was kind of a fair launch, but the first proposal was basically to allocate a certain amount of tokens to the founders, but they didn't do it. They kind of did it democratically, right? So they distribute it first and then they decided. So maybe that could be an approach to that. If that makes sense.
It definitely could be, although the founders would then run a risk, right? It's still undetermined.
Tokens,
yeah, exactly. So, and it's a really good question that you raised about, how can we put a number as to how much token is setting up a website worth? And that basically maybe that speaks to maybe we need another curve, like we need like a meta curve on top of the productivity design token emission curve that determines all the parameters. And then you get this sort of recursive loop that, we say, right, we might as well, we just have a human designer that set parameters. And then, right, let's say, the token emission is decided by this curve. But ultimately, yes, the parameters are still designed by humans. That definitely is a recursive problem.
The problem still to be solved. Yeah. Okay, so maybe let's.
I find it very interesting that you actually used the DAO example for this, because like one of my collaborators who worked with me on the curve design, Christoph and Jack, they actually came up with this prototype, like their way of thinking about this productivity linked tokenomics design is in the context of decentralized science and how to reward researchers. And it's interesting because there's actually two ways you can do this. Like the reward can be a native token or the reward can be an objective USDC terms, right?
Yeah.
And again, sort of, people need to think through this and not to just say, oh, and we're definitely going to use native token just because Curve, the stable swap, Curve the protocol uses native token, and so it's good. That's a problem in itself.
Yeah. Yeah, I guess like also an interesting thing to figure out. Still, lots of things to still figure out. So, I guess like then that's really sort of like your conclusion from this, right? To build this productivity linked tokenomics design. So look at the productivity and then answer the questions around the value, the allocation, the emissions, but do it just based on that, right? Would that be like a fair summary, an Eli 5 of the paper?
Yeah, definitely. It's the Explain Like I'm 5 version of this will be if you produce good work, you get rewarded. That's a short summary of it.
That's what the token does. So are there I mean, you've done a fair bit of research on this, and I read through a lot of the articles that inspired your paper. Are there protocols that like come close to having achieved something like that we could borrow from, or that like are at the leading edge of doing something like that?
Yeah, that's interesting. So I took a look. I think the closest one is sort of solidly. So the recent Phantom AMM swap that attracts a lot of lead gens.
Yeah.
And the creator who now quit DeFi, Andre, he airdropped this AMM token to the top 20 TVL projects on Phantom, which is a
Yeah.
L1. And the spirit is similar to this idea of productivity linked design, right? Sort of you're rewarding already productive protocols on the same layer one, and you are placing a bet that because they were productive in the past, they are also going to be productive in the future. And hence you give them more of this token. And obviously then this slightly Ponzi dynamics comes in, right? Because these are early adopters and they also want the solidly to go up, the token price to go up. So they will keep using solidly, right? In order to drive transaction volume, which actually is good for solidly itself, because that's ultimately what it wants, right?
Well, they're
The
bringing
ultimate
liquidity, and
purpose
that's
of
the goal, right? That's the value they provide is liquidity. Yeah.
Exactly. So I guess Solidly is an example, but it's slightly more exceptional because it's a protocol on a layer one that rewards other protocols in the same layer one.
Yeah.
And it's different from the discussion we've been having so far, where in our minds, we've always been imagining it's a protocol rewarding users, basically wallets, right? Rewarding wallets based on the past behavior. That's
Yeah.
a slightly different thing.
Yeah. Well, but still, I mean, linked to something productive. So,
Yeah.
And in the end, I mean, I guess like your paper was or is targeted quite generically, right? It's like everybody could use this and apply this or think through this in these frameworks that you've given, right?
Exactly. Yeah. I'm very intellectually honest. I'll say like I still haven't figured out like what's the best design, or like even
I don't think
even the
there will
trade-off
be.
between designs.
Yeah.
Exactly. Like there has to be trade-offs. But I think when I wrote the paper, the intuition that comes to me is just like forgetting about just very basic variable to sets, right? And and the fact that we forgot about token emission, token allocation, token value. This in collection is a problem, and hence I came up with the title, the three tokenomics problems.
Yeah. No, cool. I think it's I think it's a really timely piece, and a lot of people are thinking about this at the moment. So yeah, I think it's great putting this out there, and it will help more and more people to think this through, and hopefully will drive more, I guess, like innovation and experimentation with this, and that's always a good thing. That's kind of the to the what we talked about in the early part. What is this like? How do you test in production? It's bad form in a way, but on the other side, there's so many protocols that go out there and test stuff like Solidly and Phantom. They just tried something. We don't know if it's going to work. We'll see in a year or so if that was a good idea to do it. And I guess we don't, in that sense, we don't really have a test system or an accurate test system that really works. In some way, we just do it we do it more with like, we'll get protocols to put it out there and test it in production, even though it's bad form, but it will help others to learn from that.
Definitely, yeah. I mean, the fact that Curve is way ahead of its time, right? Like Curve was launched in a time where AMM was dominated by constant product, and also AMM gives out rewards based on like this vanilla mechanism, and then Curve invented this new way of doing token emission and with a bribing effect on top of it. So I guess the lesson for protocol designers and founders is basically test in production if you can. If there isn't like extreme ways that it can go wrong, but obviously like think through the edge cases and try to protect those.
Yeah, yeah. Okay, so um, one of the things that you're also interested in is stable coins, and maybe we
Yep.
can talk a little bit about that because, yeah, I I think that's stable coins are a really interesting topic, and there's a lot of innovation happening in that space too. So lots of new ideas being tested and evolved. So what are your thoughts in general on like stable coins?
Yeah, for sure. So let me tell you why I got interested in it. And so the reason I got interested in stablecoin is because I study economics and I also study game theory by training, and there's a lot of parallels between economics and finance and stablecoin. Specifically, we can look at it top down and bottom up. We can look at stablecoins top down. What does it mean? It's using the mental model from monetary economics, thinking about how countries defend the peg, or how central banks set interest rates, and how commercial banks like JP Morgan Chase or HSBC, how they have fractional reserve. And these are all valuable lessons that, for example, the founders of Frigg, the founders of Fei protocol, these are all algorithm stablecoins protocols. They openly talk about this on Twitter, and sometimes I reply to them. They reply to my tweets as well. The other way that's interesting is because it's bottom up, and if you look at it bottom up, you need game theory and mechanism design. Assume that agents are selfish and everybody cashes out from this stablecoin protocol. Basically, there's a bank run. What would happen? Then again, you can borrow literature, you can borrow theories and mental models from the game theory and mechanism design world. So that's how I got interested in it. But there's also the non-intellectual aspect that makes stablecoin very important. So what I think is, I think we mentioned this concept of Trojan horse, right, which is basically just a wedge. I think stablecoin is exactly the same way. Stablecoin is, because it's packed to one USD. People find it a lot more intuitive to use a cryptocurrency that's pegged rather than like Bitcoin or Ethereum that fluctuates a lot, right? So there's real life utility for this. That's number one. And number two, there's value proposition against status quo. Similar to how I explained Frigg and how we think about tokenizing real world assets. Stablecoins, from first principles, again, very low transaction cost, instant settlement, right? And these are a lot more easier than trying to improve upon the 1980s, 70s infrastructure of Visa, MasterCard as payment rails, or even worse, you get this interbank or international transfer system, which is slow and some paperwork as well, right? So if we just move all the payment rails, payment networks to stablecoins, everything's faster and cheaper. So that's why I find stablecoin interesting.
Yeah, yeah. Yeah, I'm just trying to think like where to go with this. I think stable coins, there's just a lot to unpack, right? They are pegged to the US dollar. Maybe we can, or a lot of them, most of them, the biggest ones are pegged to the US dollars, and there's some risks, I guess, with that in like building that. And approaches we have seen are on the one side things like what Tether and USDC do.
Yep.
They're like pretty much centralized, so they have like physical real bank accounts, and there's dollars or dollar equivalent stuff in there that they back this with. And then there's algorithmic ones like Frax and maybe UST and Luna. And how do you see that evolving, especially since what recently happened, that Luna was one of these stable coins that like came up, and I think they had a good approach, but recently they've loaded up their treasury and backed and started to back it with Bitcoin, things like that. And that for me is it is sort of a signal that maybe algorithmic stablecoins don't really work, or are they all have like this death spiral aspect. So what do you think on this? Like, where will this go between like algorithmic and yeah, really backed stable coins, like dollar backed stable coins?
Yeah, so I would question your question in a very philosophical way. Um, I would say that centralized stablecoins and decentralized stablecoins are fighting for different market share. So, and so rather than viewing them as competitors, I would actually view them as collaborators or peers that are trying to grow the stablecoin market and to replace the TradFi equivalent. On the point of fragility or sort of stability of the pack mechanism, I think centralized stablecoins are definitely here to stay. They are, and despite people talk about Tether, I also made a Twitter thread about Tether as well. After a hedge fund shorted Tether publicly, I explained the game theory behind it. Despite all the hate against Tether, Tether is surprisingly resilient. And right now, if Tether fails or depegs significantly, I guess more than 60% to 70% of crypto will just collapse. Tether's got really good coverage in non-US countries. Yeah. They work right now. They actually spent more time and energy trying to be compliant with sovereign states and work with jurisdictions. They freeze accounts, they freeze wallets, and they do so at a higher profile than Circle. So the way I see it is USDT is going to be more widely used in non-US or even non-EU. You can call it emerging countries, right? Sort of this third world country market share. USDC is going to be more used in first world countries and also be more integrated with the wider Wall Street TradFi financial system. So these two are here to stay. And then the question is, what's going to be, how will decentralized stablecoins react? And what type of user profile, what type of use cases are they going to serve? And again, as you can tell, I think from this as a very product framework perspective, and just treating the stablecoins as products ultimately. So I think it depends. You get this, and the way we predict how these decentralized stablecoins are going to play out depends on the peg mechanism. And the peg mechanism determines the use case, right? So one very intuitive thought is that the MakerDAO stablecoin DAI is over-collateralized. So as you can imagine, that serves a different use case, right? That serves for people who try to lever up, right? They want liquidity without selling their initial crypto collateral position. On the other hand, we see Terra or we see Frigg, which for algo stablecoin, Terra will be the largest. So let's stick with Terra. And Terra has a different use case, right? Terra has its own layer 1 run on Cosmos. Terra has some real world use cases. They used to use Terra for settlement for a South Korean e-commerce site. But mostly Terra, that's not anymore. Yeah, exactly. So I think most of the energy for Terra is spent on the Anchor protocol, attracting people to deposit and to offer the very attractive 19.5% APY, which is going to slowly go down, but still the the highest kind of risk-free rate that you can get in a whole DeFi world. And so USD just becomes this sort of, from what I see, like this liquidity black hole that keeps sucking liquidity out. That keeps sucking liquidity in and tries to deploy these capital into productive uses. So the way I would read it is actually, the recent 4-pool announcement by Do Kwon, collaborating with Frigg. That is actually not to increase the utility of Terra, but to increase the resilience of Terra. It's to make Terra less likely to depeg. It's to make Terra stronger, but not more useful. And that's a distinction. Can
you walk us through how that mechanism is achieved? Like how do you think that's gonna, that will achieve this?
Sure, yeah. So the announcement that I mentioned is basically Terra and Frigg are setting up a pool on Curve, which is a AMM, and it's a full pool. So it's a pool made of 4 stablecoins. It's made of 2 centralized, so USDC and USDT, Circle and Tether, plus the 2 decentralized, Frax and Terra. The outcome for this is that users can basically swap between any of the 4 stablecoins and with very low slippage. So basically think of it as this new Forex market, right, in real world and TradFi. So the reason why it makes Terra stronger is number one, more people can swap from USDC, USDT, and Frax into Terra. So, and then why would they use Terra? Because they're going to deposit it into Ankle, right? Or they're just going to join the Terra ecosystem as a whole. So this is basically like a bridge from that sucks or that guides non-Terra liquidity to the Terra ecosystem. That's one way how it makes it stronger. The other way that makes Terra stronger is Terra is just one out of the 4 stablecoins in this pool. And I saw a Twitter thread this morning, someone did the maths. It basically, because of the way Curve works, in order to depeg Terra, you need like 4,000x or 40kx more capital to depeg the same amount. So basically make it more resilient because it attracts a lot more capital now. And then obviously, there's also play such as increasing reserve via swapping assets. Terra recently swapped with AVAX to hold it in their treasury. And then they can do other stuff with this AVAX. So they can borrow AVAX, they can borrow USDC. Obviously, Terra is not doing this, I think. No one has, at least it's not public, because Terra, that would be counter the whole philosophy of decentralized stablecoins. But yeah, that's the way that this Curve 4 pool is going to make it stronger.
Yeah. I mean, it will also allow people to exit UST with a high liquidity, right? Because it will give them the ability to leave UST for other options, and that in a low slippage, high liquidity environment, right?
Definitely.
Yeah. So then, do you still think like Terra is a algorithmic stablecoin, or is it now more like a backed version?
Yeah, so this is where definition goes a bit blurry. I think by definition of the minting and burning mechanism of Terra, which they call it the seigniorage model, correct my pronunciation.
Seigniorage, yeah.
Quite seigniorage model.
I don't know, maybe that's French.
By definition, by definition, it is a algo stablecoin. However, Terra, there's a few twists, right? Terra is also a layer 1, and this UST is a native stablecoin on the chain, you can use it to pay gas fees, etc.
Yeah.
So that makes it more, better, high utility than the Ethereum equivalent, which it could be Fei or it could be Frax. That's one differentiation. The second differentiation is there's something called reserve, which doesn't directly back UST, but it can be used at this sort of in a market mechanism to buy up or sell Terra and Luna either way they want. So the way I see it is basically just the way I vision it is you can envision LFG, the foundation and the whole, basically the protocol designers and founders, and the early backers as well, because Terra is backed heavily by VCs. I see them as this ecosystem of central banks, and they are minting money out of thin air. And if people don't believe in, start to cash out, whatever, then they will prop it up because they have real money to back it up. So it's kind of similar to how you have in a past pre-fiat system, you have the gold standard, you have gold to back up USD. But can you actually redeem one USD for gold? I guess in real life you could. But nobody really did it. Nobody really did it. So I guess it's a similar way here. Would you redeem one Bitcoin with one UST? I think you can't do it now, and they probably don't want you to do it in the future either. but they want you to
and what would happen
believe
if you
that-
did, right?
Exactly.
You would
Exactly.
create this bank run because it's not 100% backed. It's like very fractional, I don't know, 12% or so. Yeah.
Yeah, yeah.
At the
But
moment,
the beauty is, I've gradually realized there is if you want to be a more optimistic observation on this, is that the 20% deposit the 20% rate that they offer can be seen as a customer acquisition cost.
Oh yeah, it's marketing.
And
yeah, purely that. Yeah,
exactly. And if you think about comparisons to other protocols or chains, I don't think there has been any other chains that has attracted so much liquidity in such a short amount of time.
Yeah.
And so I guess the question for Terra now is, are there going to be enough dApps to retain these users? And, in the Web2 terminology is, Terra nails the user acquisition part, but now can they work on user retention? Which
can it sustain this? Yeah.
Exactly. Which for this question, I have a slightly more pessimistic view than I think most people on crypto Twitter. I think that having degen protocols for lending, borrowing, NFTs, marketplaces, swaps, whatever, those are good infrastructure, but those are rather useless, to put it bluntly. I'm a real world assets maxi, which I believe that the actual way that you're going to retain users is to have utility with the real world and to have like a differentiated utility as well, which means that you can't get this, you can't participate, for example, let's say you can't buy or you can't have exposure to sustainable energy infrastructure unless you go on Ethereum. Then it helps with Ethereum retaining users.
Yeah. So what other stable coins are you seeing moving ahead in this real world usage space?
Yeah, so I think DAI is moving MakerDAO's DAI is moving towards real world assets. Although the way to do it is, again, because when we talk about DAI, it's not in the same property or in the same context of stable coins when we talk about Frigg or Terra or USDC. I guess what MakerDAO is basically doing is, the right mental model here is that it's becoming a decentralized commercial bank that holds different assets on its balance sheet.
Yep.
At the moment is 100% crypto, I think, but they are trying to diversify and hold T-bonds, treasury bonds, right? And they're going to hold real world assets that are more illiquid. And then they're going to issue a stablecoin, that is redeemable for $1 or packed to $1. And it's kind of similar to how you basically just own a share in a bank, right? It's like you go to NYSE and you try to buy a share of JP Morgan, but instead of this JP Morgan share fluctuating up and down, you get this JP Morgan share always packed to $1, and what fluctuates is the supply, but not the price. And that's how market cap gets to move. And it's a different way to see it compared to Terra, where it's really not a money market fund share. It's not redeemable to anything. I guess it's redeemable to Luna, and you can say, right, Luna is a governance token that does value accrual, but it's different from DAI, right? DAI, you can get your ETH back. So yeah, in this sense, that's different.
Yeah, to a different asset. But now, since they're buying Bitcoin, stuff like that, maybe they have that in the future as well. Okay, so To wrap it up, kind of where do you see stablecoins going in the next couple of years, and then we can, I guess, finalize this session.
Yes, for sure. So it depends on what types of stablecoins. I think centralized stablecoins are pretty much a done deal in terms of their product specification. But in terms of the go-to-market, I think, like I said, I think Tether will definitely double down on emerging markets focused. And whether or not they go for a more DeFi for the people angle, that depends, because there's also a lot of competitors in that space, right? There's a reserve protocol, which is a stablecoin that focuses in Latin America for inflation, for preservation of wealth against inflation. There's also Celo Network that does mobile first DeFi for emerging markets. So that's a tough market. Circle, I see it gaining more and more of the TradFi market share and bridging TradFi institution money to DeFi. For the algo stables, it really depends. So I think there is still theoretical loopholes, theoretical vulnerability for Terra and Frigg, right? Despite how big they are. But whether this theoretical vulnerability actually plays out, I guess we can only test it against like super bear market or another high scale exploit. But there are also attempts to build even better algo stables, even more stable stables. One of them is called Gyroscope, which is a type of sort of meta stable coin. You can think of it as a diversified fund that holds different weighting of different crypto assets, and the weighting readjusts itself according to market. They haven't launched yet. They on testnet have some gamified version of it, but it's really interesting. But I guess in terms of pack mechanisms, I guess there isn't much innovation on the theoretical side. So I guess we've sort of run out of juices, and we'll see. There's only so much we can copy from TradFi. We just have to think from first principles and really use DeFi's strengths.
Yeah, I guess. And then like the interesting part will be if we'll see more stable coins that are not pegged to fiat. Because that would be like the ultimate end game to move to something like that, right? Like reserve, like the one that you said.
Yes. That is actually a very good point. I've totally missed out on that, like non-pegged USD stablecoins. There's also like Reflexa Finance, Rye, that aims to be a pegged to an arbitrary number and be this denominating factor across crypto. I think theoretically it works. Like the peg mechanism, it's very big brain. They use, they were one of the early protocols to use PID controller to dynamically adjust the weighting of assets. But the problem is it's still like from a user perspective, right? It's still not intuitive. And particularly, I guess, the most bullish case I would give for non-pegged stablecoin is we need pegged stablecoin to onboard everybody to crypto. And then once everybody gets comfortable with crypto, then they can convert this pegged stablecoin into non-pegged, and then we get the truly crypto native denominated stablecoin. But that's going to be, we're going to have to wait until blockchain runs the world. Even the internet hasn't run the world yet.
Yeah. That's a very long way ahead, I guess. And to me, like I think like all these unpegged ones, they're still super unintuitive and like difficult and hard to understand, wrap your head around how they actually work, right? What country they kind of represent with the currency that they create. So yeah, cool. Is there anything you'd like to, say that we haven't talked about yet before we wrap it up?
No, I think this is pretty much it. This has been a really good conversation.
Cool. Yeah. Likewise. Thanks for coming on. Thanks for taking the time. And yeah, cool. I guess we'll be in touch.
Thank you.
Stablecoin space.
Cheers.
And then the token valuation space. Thanks everyone.
Yep.
Thanks, Jack.